Most people pick stocks based on hype, but real investors follow a system. Because finding winning stocks isn't luck, it's a repeatable process. And once you
All right, so you want to know how to pick growth stocks. Well, today, we're not just going to give you a hot stock list. That's not the point. We're going to do something way more valuable. We're going to peel back the curtain and show you the thinking, the actual process an investor uses to find companies that could have some serious potential. We're building a framework you can use for yourself.
So, here's the game plan for today. First, we'll talk about how to even find these opportunities. Then, we'll get into the nitty-gritty and decode a couple of key financial clues. After that, we'll put it all into practice with some real-world case studies, tackle the big question of market volatility, and then, finally, wrap it all up into a framework you can take with you.
Okay, so where do we even begin? Well, the first step is all about learning to look past the day-to-day noise. The hype, the headlines. It's about finding a company with a really compelling story, one that gives you a reason to believe it has a ton of room to grow.
And that time frame, that is everything. We are not trying to guess what a stock's going to do next week or next month. The whole focus here is on the next 3 years. It's a huge mental shift. You're looking at the actual business and asking, hey, where could this company be in 3 years? It's the difference between gambling and true investing.
Okay, so you found a company with a story that gets you excited. What's next? Well, now we have to check the numbers. We need a toolkit, and we're going to break down just two super important financial terms that investors use to see if a stock might actually be a bargain. First up, the forward PE ratio. And look, don't let the name scare you. Just think of it like a price tag. All it does is compare the stock's current price to what Wall Street thinks it's going to earn next year. A lower number here can be a hint that maybe, just maybe, you're not overpaying for that future growth.
Let's make this real. The source material brings up e.l.f. Beauty, the cosmetics company. At the time, its stock had a forward PE of about 18. Now, is that high? Is it low? Well, honestly, it depends. It's all about context, and specifically how fast the company is expected to grow.
And this quote right here, this is a perfect window into the investor mindset. The source literally calls a PE of 18 laughable. But why? Because if you have a company that's expected to grow like a weed for years to come, paying 18 times what it's going to earn next year, that starts to look like a really, really good deal. This is how you spot what might be a mispriced opportunity.
All right, the second metric is free cash flow. And this one is so important. This tells you how healthy the business really is. After a company pays for all its inventory, its buildings, its employees, everything, this is the actual cash that's left over. It's kind of like the company's take-home pay. And you know what they say, cash is king.
So here's the key. You're looking for a story in the numbers. You want to see a company that's already generating cash, for sure. But the real magic is finding one where that cash generation is about to hit an inflection point. The source uses the word explode. That's the kind of potential you're looking for, a sign that things are about to get really profitable.
Okay, theory is one thing, but let's see how this all works in the real world. We're going to dive into those two companies from our source material and really apply this framework.
So first up again is e.l.f. Beauty. You've probably seen their products. Their strategy is brilliant in its simplicity. They make great makeup and skincare, but they sell it at prices that people can actually afford.
Now, the investment story here isn't just some vague feeling. It's built on solid pillars. 1, they just bought a really hot, successful brand. 2, their core business model, quality for less, is a massive winner. And 3, they've barely scratched the surface of selling their products overseas. That is a huge runway for growth.
Now, look at this. This is so interesting. This is how an investor really thinks about the future. It's not about one single prediction. It's about mapping out a range of what could happen. You've got your bear case, if things don't go so well, the base case, which is what's most likely, and the bull case, if they absolutely knock it out of the park. It's all about understanding the potential risk and reward.
Okay, let's switch gears. We're going from the beauty aisle to the beverage aisle with Celsius Holdings, the energy drink company that has been on an absolute tear.
The growth story here is different, but the thinking is exactly the same. So what are the key drivers? Well, 1, they own some incredibly popular brands. 2, they're expected to keep growing fast no matter what the economy does. And 3, this is huge, they have a monster distribution deal with Pepsi. That means their drinks are everywhere.
And would you look at that? Same exact framework as with e.l.f. The investor maps out the possibilities. This isn't about having a crystal ball. It's about having a disciplined way to think about the potential future of the business.
This all sounds great, I know, but we have to talk about the scary part, the elephant in the room. What on earth do you do when the market just goes completely crazy? This is probably the #1 fear for every new investor.
I mean, it's the nightmare scenario, right? You do all your homework, you find a company you love, you put your money in, and the next day, bam, the whole market takes a nosedive. Now what?
And you know, I love the honesty from our source material on this. It admits point blank that in the short term, anything can happen. A fantastic company can still see its stock price get crushed in a panic. The market, as it says, can be crazy.
So what's the secret? It's learning to separate the business from the stock. The strategy is to stay laser-focused on that 3-year outlook. If your long-term story is still true, then a sudden price drop is just noise. The source even calls it silly pricing. Having that long-term conviction is what allows you to ignore the short-term craziness.
Okay, we have gone through a lot. We went from finding a story, to checking the numbers, to dealing with fear. So let's bring it all home and put this into a simple process that you can use over and over again.
And here it is. This is the whole thing in a nutshell. Step 1, find that compelling 3-year story. Step 2, check the price tag with something like the forward PE. Step 3, make sure the company is financially healthy by looking at its free cash flow. Step 4, accept and prepare for the fact that the market will go up and down. And finally, step 5, commit to that 3-year plus time frame to give your idea a chance to work.
So I'll leave you with this final thought. You now have a basic toolkit to look at the business world a little differently. So think about a product you absolutely love, or a company you interact with every single day. What's their growth story? What do their numbers say? You might find that the next great idea is hiding right there in your daily life.
If you want to learn how to think like an investor, not a gambler, subscribe. That's what we do here.